Today we're going to be talking about Realm Capital, what we do, as well as comparing this and our 12-month exit strategy versus a multi-year syndication. So before we jump in, we are an SEC filed fund under Reg D 506C. So we always like to appease our friends over at the SEC. We've got this disclaimer at the bottom. Basically, it states that all investments do have some level of risk and there are no guarantees in any investment, and past performance does not guarantee future results. So now that we've gotten that part out of the way, we're going to jump in. We will have an opportunity if you have any questions at the end that I will be taking a Q&A. So jumping right in, what we're going to be covering today, I'm going to be going over a little bit about Realm Capital, our model, what we do, and how we earn our investors' returns, and then some example projects as well as returns that those projects yielded. And then we're going to kind of go deeper into how this structure compares to a multi-year syndication. So a lot of times when people think of investing in alternative investments besides the stock market or mutual funds, maybe bonds, CDs, they will look at real estate. If they're not an operator themselves, they'll look to put their money with an operator that they trust, someone who has a proven track record. And a lot of times they'll start looking at multifamily syndications. So we're going to be talking about and comparing and contrasting both of those. And then we're going to wrap up with some Q&A. So we'll just jump right in. And a little bit about myself before we get started. I've been in residential real estate for the past 23 years. I've been a licensed broker and an agent. I've had a team of agents that work for me. And over that time, I've sold over $700 million worth of properties. So most would consider me an expert in the residential real estate field. 700 closed transactions. And as far as real estate investments go, in my flipping journey of buying homes, remodeling them and reselling them, I've done well over 200 fix and flip properties at this point in my career. I'm the founder of Realm Capital, as well as Realm Residential, and then Fair Property Buyer, which is our company that does direct marketing to consumers, letting them know that we can make them a fair cash offer on their home. If you are on Instagram, feel free to look me up on Instagram at Gabe Cole Real Estate, and you can follow along, see kind of behind the scenes, see some of our other past projects, and what we've got going on in the real estate space. So let's talk a little bit about Realm Capital. Again, I mentioned I've been doing this for 22 years. I just formed Realm Capital this year. So we've now been operating just for about 4 months now. Obviously, as an experienced operator, I had people that were wanting to participate in the returns that I was able to offer on my projects. And now I've officially launched Realm Capital, which allows me to kind of open this up to more people. I used to have it available to really kind of friends, family, clients that have worked with me in the past. And now I am officially filed with the SEC as an investment fund, and we focus on the acquisition and revitalization of distressed, underutilized properties throughout Southern California. So what we do is we specialize in identifying these undervalued assets, and then we purchase these properties at a discount. We then go ahead and manage the design and the construction and the redevelopment, while then executing the subsequent profitable sale after completion. Now, because we are filed now with the SEC, we are open to accredited investors only at this point. So in the event that we open up a second fund in the future, that could be possibly for unaccredited investors, but right now we are only for accredited investors. So what does that mean? An accredited investor defined by the SEC is an individual or entity that has a minimum net worth of over $1 million, excluding their primary residence, or an annual income exceeding $200,000 for an individual, or $300,000 if you're filing jointly, and therefore you're eligible to invest in private offerings like this. So if that is not for you, I wouldn't be offended if you jumped off right now, but at this point we are only open to accredited investors. So here's a little bit about our investment strategy. We offer accredited investors a secure, high yield, and low liability way to participate in real estate without the headaches of direct ownership. Along with that, because we specialize in value add properties, a lot goes with that. Managing the contractors, the design, all of the additional work that we need to do to manage these properties. We handle all of that, and our investors basically they get to sit back and they get to collect quarterly cash flow. So some of the key benefits that we offer to our investors, they're backed by prime Southern California properties. We're not investing in other states at this point. We are only investing in Southern California, and that will mostly be in Orange County, where we're headquartered. And then occasionally we will be looking and purchasing properties in the surrounding counties, such as Riverside, Los Angeles, and San Diego. We offer consistent cash flow and strong returns, which I'll be getting into, depending on the level of investment that you would be interested in placing. And we offer a high liquidity with flexibility. We're going to go into that, but basically we do a 12-month lockout period. So if you want your money back in a year, you give us notice and we would then pay you back. And that's going to be a very short period of time if you were considering something like a multifamily syndication, which can be 4, 5, 6, 7 years. So we have no management fees and no management hassles as well, which I'll be going into a little bit more. And sometimes people will invest with an individual like on a one property basis. Well, we lower the risk by spreading out the risk across a portfolio of properties, not a single asset. So if you were going to go invest in, let's say, a multifamily syndication, you're investing in one deal. And if something happens in that market, let's say it's a suburb of Atlanta, maybe there's widespread job loss, maybe the property experiences some issues on the management side or on the construction side, then all your eggs are in that one basket. Well, we spread them out on all the properties that we buy. So you're basically diversifying your risk, not in one single asset like you would be doing in a multifamily syndication, but in all of the assets that we are purchasing for a short-term renovation and sell. So here's a little bit more about what sets us apart. I think our deep local expertise is something that's very important. I've been in 22 years in real estate full-time in Orange County. So why that matters, and that's going to the next point, is trusted relationships. Real estate is definitely a relationship business. And, I mentioned earlier on 700 properties sold. I have been on the other side of a lot of transactions with other agents. So my network at this point has grown tremendously over the years. And why that matters is because a lot of times agents will actually bring me deals. Because I do a lot of coaching and I do a lot of training, and agents know that they can trust me because I've built a sterling reputation over the years. And why that matters is because I have an army of agents that are out there looking for properties and I'm their client. Even though I'm a licensed agent myself, I teach agents that they can bring me a deal. Let's call it a fixer-upper type property or something that's really dated or in really old condition and needs to be renovated. Well, they bring that deal to me. Sometimes they bring it to me. Often they bring it to me not even on the market. If they just get wind or they have a conversation with someone who just inherited a property and they're looking for like a quick sale, those opportunities are getting brought to me. And so if you're investing in an opportunity like this, you want an operator that's been in that marketplace for a long time and has access to these deals. And over the years, we've also developed systems and processes. We've got a process where we've implemented with an experienced team. In the acquisitions process, we focus on direct to seller marketing and systems that connect us with our ever-growing database of local agents. So let's talk a little bit more about how we do that. So we acquired properties through direct to seller marketing. And what that means is we actually have marketing campaigns that go out to homeowners that are of specific types of properties. So typically we're looking for aged properties. The average property that we buy in Orange County is typically built in the 1960s and 1970s. We occasionally get some that are newer, but that seems to be our sweet spot. And the reason for that is if those homes have not been touched or updated for all of those years, they are in dire need of a rehabilitation. So we've got campaigns that go out direct to sellers. We've got campaigns that go out to establish our broker relationships. We already have a very large brokerage network that brings us deals, but we're always looking to grow that. Um, we also have a wholesaler network. These are companies or people that actually just try to find these off-market fixer type properties, but they don't necessarily want to be the ones that do the fixing and flipping themselves. So they actually try to add a fee onto it and pass it on to someone like myself who is actually doing the renovation work and rehabilitating the property. So they will bring me their deals, and I get emails and texts and calls from these guys on a daily basis because they know I'm a real player in the industry, actually going out there and fixing up and buying properties. So our underwriting team, we evaluate hundreds of deals on a monthly basis, and majority of them we pass on. And I'm going to go a little bit into that in another slide. We have very strict underwriting standards. So if a property does not meet our underwriting standards, we will not purchase it. I have my own money invested in these properties as well, just alongside my investors. So I take your money and my investors' money even more seriously than my own money, because I would never want to be in a position where I have to tell my investors that we've lost principal. I think that's the utmost important thing when managing a fund. So we evaluate properties based obviously on the future value of what the home will be worth once we fix it up, and we have to have it meet a minimum projected return threshold in order for us to move forward and purchase that property. So here's kind of a little snapshot of a little bit behind the scenes of what we do on our deal analyzer, of how we're evaluating properties, what the minimum return is that we're looking for, and then how we're evaluating them basically on a comparable analysis. So we do a strict comparable analysis of every property that we're looking to purchase, and what we are typically doing is looking at what the future value is, right? So if a property gets brought to us, we're looking for what that home will be worth once it's completely fixed up and renovated. And then we work backwards from there. So as you see at the top of this page, it gives an address, project months, and then ARV. ARV stands for after repair value. So that's really what we start out with. It's almost like, what is this property going to be when it grows up, right? Once we renovate it, what is this property going to be worth? And then we back into it knowing what our projected rehab costs are going to be. And we've gotten this down to basically a science because we've done so many of these at this point. We know what it's going to cost to replace a kitchen. We know what it's going to cost to replace every bathroom. What we pay for a medium-sized to large-sized master bathroom, what we pay for a standard secondary bathroom, what we pay per square foot for flooring, windows, roof, HVAC. We have all of these costs computed. So we can look at photos of a property and have a very good idea of what that is going to cost us. But before we actually purchase the property, we're always doing a walkthrough of it, and we're doing an inspection with our construction team to make sure that there's no surprises prior to making the final purchase of that. So here's a couple of examples of some deals that we've done. Some of them have been quite recent. This was a property that we purchased in Laguna Niguel. Most of the properties that we buy, we like to be in and out of them within 6 months. And that does a couple of things for us. One, that hedges our risk because, if we're in and out in that short of a time period, if there is any market fluctuation, it is somewhat minimized by the short term that we're holding these properties. If you're buying into a, longer term syndication, there's a lot more risk or chance that the market can turn over a 2, 3, 4 year time period than it can in a 3 to 6 month time period. So this particular property we held longer, and that was for a reason. We made a decision on that one to do actually a larger renovation because we knew we would be able to push the value of the property a lot more. So this one was a 10-month hold. but we did a pretty substantial remodel on this property. This was one that was brought to us off market. It was a direct to seller transaction, and we purchased the property for 1-1. This was an inherited property, and the home was a 1960s build and was pretty original inside. When I say pretty original, I'm talking about it still had the 1960s green avocado carpet on the inside of it. So this one had, needed everything. We needed to open up the walls. We needed to do new windows. We completely reformulated the floor plan. We took out a huge fireplace that separated the kitchen from the living room. And then we did, all new landscaping, hardscaping, and repipe, electrical, all of that. So that was a larger than typical rehab that we do. That was a $425,000 rehab. But we made that choice rather than doing like a $200,000 remodel on it and selling for a lot less. We knew in that neighborhood that we would be able to push the price substantially because it had a view, and view single story homes in this neighborhood were really hard to come by. So we pushed the value on that one up to 2.4 million, and that was a 10-month hold. So the profit on that one was 640,000. Here's another one we did in Costa Mesa. This one was a $765,000 purchase price. We put about 250K into the rehab, and we sold it for 1.4 million. And that one was an 8-month hold, netting approximately a $200,000 profit on that one. And you can see the before. This was actually tenant occupied by the same tenant for 15 years. And the tenant was the kitchen here was actually probably one of the best parts of the house. This house was actually rat infested. The tenant was a hoarder, and the owner, which was an investor that owned this property for I think 30 years as a rental, they rarely ever checked up on the property. So the tenant that was living there for 15 years literally just let it go, and was a pretty terrible condition. So when the owner saw it, he did not want to deal with cleaning it up and selling it because he knew everything had to be ripped out. He was just looking for a quick, easy sale. He bought that property for I think 200,000, and he just knew that like rather than spending the money himself to fix it up, he just wanted to be done with it. So we came in, made him a quick cash offer, and it fit his needs. Here's another one in Lake Forest, California. So 750 purchase price. This is one of those quicker ones. The owner also was moving out of state and had privacy top of mind. They did not want to put it on the market, and they did not want, a lot of people coming through. That one came to us from an agent that we knew, and they brought us in, and we made a quick offer on it. We bought that one for 750 with a $125,000 rehab, and we were in and out in 3 months. The remodel on this house only took us 30 days. We put it on the market. We actually sold it right away and then closed about 30 days after that. So that one was a 3-month hold. Average of our properties that we've done historically is a little over 4 months. It's about 130 days. So we really try to target 4 months, but we, budget in a 6-month hold on most of our properties in the event that there's a construction delay, or, maybe we lose a buyer and we have to go back on the market. So we typically target 6 months in our pro forma. Oftentimes we're able to get it done sooner than that. So, what is a debt fund? A lot of times people think debt and they think, okay, loan or leverage on the property. So, what we do is rather than offering investors like a management fee and then some crazy what they call a waterfall schedule where investors get the first 6 or 7% and then there's a catch up and very, very complicated, and then the manager of the fund gets, the next 6 or 7%. And then if it's over a 15% yield, we didn't want to do any of that. We wanted to be very clean and simple. So we offer accredited investors fixed returns with quarterly cash flow. And so we basically have a private investment vehicle that allows accredited investors to earn fixed returns secured by all the property holdings owned by the company without having to own or manage the real estate themselves. So basically, in simple terms, we offer fixed returns based on the amount of money invested. And then there's quarterly distributions that come with that. So now we're going to start comparing it to like what a lot of people have heard of, which would be a multifamily syndication, right? So here's like a 200 unit apartment building. And the syndicator of this property might tell you, okay, we're looking to hold this property for 4 to 5 years. And the business plan is to renovate the units, increase the rents, stabilize the asset, and then maybe eventually sell the property. Well, the returns on this are dependent on market and sale timing. So let's say in 5 years, interest rates are higher than what they are now. Well, that's going to dramatically change the value of that property because investors will buy based off of a cap rate. And when interest rates go up, well, the price of the property is going to have to go down. So it's very interest rate sensitive at the time of exit. Operators in a syndication, they receive all sorts of different fees. If you've looked at any of their private placement memorandums, they receive a management fee based on the property. They're going to receive like an acquisition fee. So like if this was a $10 million building, they may receive 1 to 2% or 100 to $200,000 just for acquiring the property. They also will typically put in things like a disposition fee. When they go to sell the property, they'll take another 1 to 2%. So even if the property does not perform as well as what their business plan or performa says, they're still collecting fees along the way. So what we do differently here at Realm Capital is we offer liquidity and flexibility. So your capital is not tied up for 4 to 7 years, like in a multifamily syndication. And you know what happens in a multifamily syndication, or what can happen, is if that property is not worth what they think it's going to be worth in 5 years, the manager can say, "Well, we're going to hold it for a few more years to see if we can hit our number." And so you, as the investor or the limited partner in that deal, are kind of at the whim of, not the whim, but the manager of that situation, because they're in charge of saying like whether they're gonna hold it a little bit longer or wait or refinance. So with us, it's a 12-month exit option. Investors can access their capital in 1 year while receiving quarterly distributions for cash flow. If you want to let it go longer than a year, obviously you're perfectly able to do that. We just require a 1 year minimum. So let's say you knew you wanted your money only out there for 1 year. Well, you put your money in, you give us notice right away, and at 12 months we pay you off. We offer shorter timelines, faster reinvestment opportunities, and greater control of your capital. So that was something that was really important to me. I wanted flexibility for our investors. I wanted to offer a great return for them, but I also wanted them to be able to get their money back because things happen. Family situations come up. Maybe you don't want to have your money in an investment for 4 to 5 years, right? Like maybe you need it back sooner than that. So predictable fixed income versus cash flow uncertainty. So our debt fund offers 9 to 12% fixed annualized returns. And I'll be going over this in a few further slide, dependent on the amount invested. So we do quarterly payouts, and it's not dependent on a single property performance. Syndications, many of them advertise quarterly cash flow, but they often fail to deliver because the properties aren't producing enough income early on. So I actually know quite a few other guys in the space that are in the multifamily space, and I know even recently they've been having trouble meeting any sort of cash flow distributions. Doesn't mean that investment is going to completely fail, because they may still be able to get the return to their investors when they sell it. But I even have a friend who's in a multifamily syndication right now as a limited partner, and he told me they completely paused distributions because they're renovating some units and there's just not enough cash flow to pay out any sort of dividend to the investors. So in reality, in many deals, investors don't see distributions for a couple of years, and most returns only come at the sale, and that could be often in year 5 or beyond. So with Realm, the returns start immediately, and they're consistent quarterly payouts. So a lower risk profile. So investor capital is diversified across a portfolio of multiple short-term real estate projects and not tied to a single property. I mentioned that before. And we also maintain a conservative loan to value ratio. So basically, what we do is the funds that we raise from our private investors with Realm Capital, we're utilizing those funds for the down payment and renovations of these properties, but we will also leverage at a lower interest rate with a third party bank or financing company. So typically, what we're getting our bank financing for is in the 8% range. That is not conventional lending because a lot of the properties we buy will not qualify for conventional lending. We use a basically a private money bank that loans to does short-term 12 to 18 month loans on specific properties. But what's important for our investors to know is we do not over leverage the property. So we have a formula in our underwriting that we will not go higher than 70% of the after repair value on leverage. So if we're taking on a loan from the lender, we're capping that at a $700,000 loan if the property fixed up is worth $1 million. And why that's important is some investors out there will take their leverage a lot higher than that. And if there is any hiccup in the market, then at that point they could end up being, underwater if they took out 90% financing or something like that. So we leverage conservatively to protect the capital of our investors. We also offer no management or performance fees. So what this means is if a single project underperforms, we as the management team can't take profits until investor returns are fully recovered on future projects. So let me explain what that means. Let's say we have a single project that doesn't perform as we thought. Maybe there was a big surprise that we found out once we opened the walls. Maybe there was something that happened during the remodel that caused us to go over budget. Let's say we end up, not losing money on that project, but maybe we only made a small amount on that project. Well, we can't take any distributions until we've met the hurdle of our basically our investors' returns. So, like I mentioned earlier on multifamily, they're still getting acquisition fees, they're still getting management fees. I think this structure creates alignment of interest between the manager and the investors, and it also emphasizes stability and accountability. So we do reports to our investor database, letting them know about the projects that we're doing, the types of returns that we're getting on those projects. And we can't take any distributions if we're behind on the overall returns. So simplicity and transparency. Realm Capital Fund is a straightforward structure. I mentioned a little bit about this earlier. There's no profit splits, waterfalls, or hidden fees like you'll typically find in a syndication. And it's a straight return. You know what you're getting when you sign up for it. We offer 9 to 12% returns, and I'll go into the minimum amount invested in a future slide. So syndicators, they're often very complex, right? Like it's going to take you and your CPA to sit down and really figure out. Dan, I see you on the call here. Like I know you're a retired CPA, so you're going to have to really go through this kind of stuff with a magnifying glass on figuring out what the splits are going to be with all the fees and everything. With Realm, what you see is what you earn. It's clear terms, it's a fixed yield, and it's transparent reporting. So diversification and deal flow. So Realm Capital, it's capital pooled across multiple short-term projects, reducing the exposure to any single property or market. Syndication, you're putting all your eggs in one basket. It's one building, and if that property struggles, if they're having trouble with their business plan or executing, so do the returns to all the investors. So our advantage, we've built in diversification across several projects in prime Southern California markets. And I think that really helps limit the investor exposure. So in the event that you have a retirement account, a 401k, a Roth IRA, a regular IRA, There's an opportunity if you don't already have one. There's something called a self-directed IRA or retirement account. Normally, it's referred to SDIRA as short, but we are eligible to take self-directed IRA money. So if you are an investor and you've got already have money in a self-directed IRA, well, you could invest directly into our fund with that. If you want to learn more about how self-directed IRAs work, I've got some great partners that can help, walk you through. I work with UDirect IRA, which is also located right here in Irvine, and they do a great job for their clients setting them up with self-directed retirement accounts. So there's something that's very important if you were to invest in this fund, in our fund with a self-directed IRA. There's something called UBIT. Now, UBIT stands for Unrelated Business Income Tax. Now, basically, UBIT, it's a tax the IRS charges when a retirement account earns income from an active business or leveraged investment rather than passive interest or dividends. So why does this matter? If you are investing in a self-directed IRA, in multifamily syndications, they almost always will use leverage. None of these operators are buying a 10, 20, 30, 40, $50 million building all cash. They're using a loan to buy it. Now, the leverage is what actually creates the UBIT exposure, and this can erode returns inside the retirement accounts. Now, with Realm, our advantage, because it's a pure debt investment, investors using retirement funds avoid UBIT entirely, keeping more of what they earn. Now, I know that was kind of dry and a little bit of a mouthful, but let me kind of give you an example of what that looks like in real life. So, if you were to make a $250,000 investment in a syndication with leverage, a 12% gross return. Now, this is on average. It depends on what your tax bracket is and all of that. But on average, you're going to lose about 3 points with a deal that has 70% leverage. So if you got a 12% gross return from a leverage syndication like a multifamily, that really turns into 9% after the UBIT. With Realm, our 12% is what you get. There's no UBIT tax if you have a self-directed retirement account because we are a debt fund. So 12% gross return equals 12% net because there's no additional tax. So let's talk about the minimums for our investments and go then into kind of what those return. So our minimum investment to buy one share with Realm Capital is a $25,000 minimum investment for accredited investors. Syndications typically don't go that low. Syndications will typically have a 100K minimum. Some will even have higher, 2 to 250. And that, again, that's no liquidity for years. Your money is going to be tied up for at least 4 or 5 years on the low side. So we offer a lower entry threshold and faster feedback cycle for investors seeking immediate performance. So let's go a little bit further into the overview of what we offer. So Realm Capital is a debt offering. You enjoy the rights of lenders, including promissory notes against all the properties in the fund, generous cash flow interest income paid quarterly, the high liquidity, which we talked about, which is a 12-month notice for withdrawal. It's hassle-free. There's no day-to-day decisions. Once you make that investment, we're handling everything. There's no upfront fees, no management fees, and no disposition fees whatsoever. I really wanted to create a simple fund structure, one that charged no fees to the investor that was investing with us. So here is a little bit of a breakdown. So a minimum of a $25,000 investment gets 9% interest. For a $100,000 investment, it's 10% interest. And for a 12%, that's a $250,000 minimum. And you get payouts on a quarterly basis. So March 31st, June 30th, September 30th, and December 31st. And then a little note at the bottom, all investors must be accredited with SEC Regulation D. No acquisition fees, no management fees, no withdrawal fees, no fees, period. So we actually, when you get started, would have you declare yourself as an accredited investor, but we do actually have to go through for the SEC Another process, it's very simple for you to become an accredited investor. There's a form that you could fill out. We use a third-party company that will verify it. The simplest way to do it is if you get a letter from your licensed CPA or licensed financial advisor, basically just stating how you qualify as an accredited investor, either by income, 200K a year income, or 300 filed jointly, or $1 million net worth excluding your principal residence. They would sign that basically form, and then we hold that on file for our compliance. So if you are wanting to learn more, there's a couple of ways you can do that. You can scan the QR code or just type in realmcapitalfund.com into your browser. That will take you directly to our website. If you are wanting to book a call with me to go over your specific situation, if you have any questions, you can book a call directly from our website. I'll show you where you can do that right there. When you get to our website, there's a Get Started button and there's a Book a Call button. If you were interested in getting started right away, you could just click the Get Started button. That will take you to the short form questionnaire where you can self-declare yourself as an accredited investor. And then it will be an option for you to tell me what time works for you for a call, and then we'll get you onboarded. Or you can just book a call directly with me, and then we can answer any questions that you might have. So I'd like to, at this point, thank you for coming and joining us, and open it up to any Q&A you might have.
Gabe, can you hear me? This is Dan.
I can hear you, Dan. How are you?
I'm pretty good. How about yourself?
I'm doing great, thank you.
So the 12-month period, and say you decide at the end of 12 months to stay invested, does that start another 12-month clock, or can you get out, say, in 18 months, a total of 18
Good question. So it's a 12-month minimum notice. So if you were thinking you wanted to be out in 18 months, then you would give us a notice at 6 months, and then you'd get out at 18. And then if for some reason you change your mind, you wanted to keep it rolling, you could let us know, and then we would keep that investment rolling. So in the event that you waited 12 months and then you wanted it out in 18, we can't make any guarantees because that money could already be allocated towards a project. So we would always make our best effort. For example, if we're between projects and have capital available, we would tell you like, hey, Dan, maybe we can just pay you off in 30 days instead of 6 months if that works for you. Otherwise, this money is going to get earmarked for another project. So we can kind of work with you in that effect, but basically a year, the PPM spells out a year notice in order to get the funds returned. So if you thought
months?
it's only going to be 12 months that you want it working for you, you give us notice right away. If you thought maybe you'd want it out 18, you give us notice at month 6.
Got it. Thank you.
Yeah, absolutely. Any other
You,
questions?
yeah, if I might, one more. This is just curiosity question. It seems to me at one time you were investing in Texas, and
Yes.
now you say all of this is Southern California.
Correct. Correct.
Okay.
Yeah, we our comfort level is in Southern California, and honestly, Texas, their market was fluctuating quite a bit more in Texas this year than it was here in Southern California. So from that standpoint, this market I feel like is a stronger market to be doing it in. We only did 2 projects in Texas. Neither of them performed as well as our projects here in Southern California. So what we're looking to do with Realm Capital in the short term is we're trying to raise 5 million in order to do a lot more projects here in Southern California because obviously the price points are quite a bit higher here as well. And we really want to focus. And because I've been here for so long, 22 years, all in Orange County, I pretty much know every submarket in the entire county. So I know what buyers are looking for here. I know what sells. I know what doesn't sell. So I'm really honing in on what we know and how we operate best. Our best construction crews are here. So, rather than, trying to take less capital and go to a lower cost state where we're more spread out, we're trying to raise more capital and go in where we're true experts and leaders in the industry here.
Lastly, having a self-directed IRA, but being retired for several years, how is there a mechanism? Well, you said you had some people maybe contact. How do you direct cash you have in an IRA to invest with you?
So
What's the
do you have already a self-directed IRA or just an IRA?
no, that's self-directed.
Okay. Do you have checkbook? Is it a checkbook or do you have a custodian?
Oh yeah, custodian.
Yeah. So basically, you would once you sign up, you tell me that you wanted to do it in your IRA, and then basically your custodian, we would give the wiring instructions for the deposit. Your custodian would be the one that would send it, and if you put us in
Okay.
contact with them, we can coordinate all of that.
Okay. Very good. Thank you.
Yeah, absolutely. Everything else going well with you?
Yeah, yeah, just getting older, you know.
I
But
hear you, but
other than
what?
that, life's pretty good. I can't complain.
Good. You still liking you still get making it to the swimming pool?
Yeah, I am. I am. I'm slowing down a little bit, but I still get there at least,
Well,
try to get there at least 3 days a week.
that's all that matters, Dan. You just keep at it. That'll keep you young.
I don't know about that.
Well,
I think it just
keep
slows down
moving.
the aging process and doesn't keep you
Yes.
young. It's
Yeah.
not like a fountain of youth.
Just keep moving, buddy.
All right. Thank
All
you.
right, buddy. Good seeing you. All right, thanks. All right. Well, if there aren't any other questions, I'm going to hop off. You can book a call with me if you'd like to ask any personal questions. If you're ready to join, you can just go to realmcapitalfund.com, click invest now, and that will start the process. But look forward to connecting with you soon, either on a personal call. Let me know if you have any questions or if I can be of any future help. Thanks a lot.